Postscript. We know very well two partners who spent a good part of their lives handling their own and other people's funds on Wall Street. Some hard experience taught them it was better to be safe and careful rather than to try to make all the money in the world. They established a rather unique approach to security operations, which combined good profit possibilities with sound values. They avoided anything that appeared overpriced and were rather too quick to dispose of issues that advanced to levels they deemed no longer attractive. Their portfolio was always well diversified, with more than 100 different issues represented. In this way, they did quite well through many years of ups and downs in the general market. They averaged about 20% per annum on the several millions of capital they had accepted for management, and their clients were well pleased with their results. In the year in which the first edition of this book appeared, an opportunity was offered to the Partners Fund to purchase a half interest in a growing enterprise. For some reason, the industry did not have Wall Street appeal at the time, and the deal had been turned down by quite a few important houses. But the pair was impressed by the company's possibilities. What was decisive for them was that the price was moderate in relation to current earnings and asset value. The partners went ahead with the acquisition, amounting in dollars to about 1/5 of their fund. They became closely identified with the new business interest, which prospered. In fact, it did so well that the price of its shares advanced to 200 times or more the price paid for the half interest. The advance far outstripped the actual growth in profits, and almost from the start, the quotation appeared much too high in terms of the partners' own investment standards. But since they regarded the company as a sort of family business, they continued to maintain a substantial ownership of the shares despite the spectacular price rise. A large number of participants in their funds did the same, and they became millionaires through their holding in this one enterprise, plus later organized affiliates. Ironically enough, the aggregate of profits accruing from this single investment decision far exceeded the sum of all the others realized through 20 years of wide-ranging operations in the partners' specialized fields, involving much investigation, endless pondering, and countless individual decisions. Are there morals to this story of value to the intelligent investor? An obvious one is that there are several different ways to make and keep money in Wall Street. Another, not so obvious, is that one lucky break or one supremely shrewd decision, can we tell them apart, may count for more than a lifetime of journeyman efforts. But behind the luck or the crucial decision, there must usually exist a background of preparation and disciplined capacity. One needs to be sufficiently established and recognized so that these opportunities will knock at his particular door. One must have the means, the judgment, and the courage to take advantage of them. Of course, we cannot promise a like spectacular experience to all intelligent investors who remain both prudent and alert through the years. We are not going to end with J.J. Raskop's slogan that we made fun of at the beginning: everybody can be rich. But interesting possibilities abound on the financial scene, and the intelligent and enterprising investor should be able to find both enjoyment and profit in this three-ring circus. Excitement is guaranteed. Commentary on Postscript. Successful investing is about managing risk, not avoiding it. At first glance, when you realize that Graham put 25% of his fund into a single stock, you might think he was gambling rashly with his investors' money. But then, when you discover that Graham had painstakingly established that he could liquidate Geico for at least what he paid for it, it becomes clear that Graham was taking very little financial risk. But he needed enormous courage to take the psychological risk of such a big bet on so unknown a stock. And today's headlines are full of fearful facts and unresolved risks. The depth of the 1990s bull market, sluggish economic growth, corporate fraud, the specters of terrorism and war. Investors don't like uncertainty. A market strategist is intoning right now on financial TV or in today's newspaper. But investors have never liked uncertainty, and yet it is the most fundamental and enduring condition of the investing world. It always has been, and it always will be. At heart, uncertainty gives the ability. At heart, uncertainty and investing are synonyms. In the real world, no one has ever been given the ability to see any particular time, to see that any particular time is the best to buy stocks. Without a saving faith in the future, no one would ever invest at all. To be an investor, you must be a believer in a better tomorrow. The most literate of investors, Graham loved the story of Ulysses, told through the poetry of Homer, Alfred Tennyson, and Dante. Late in his life, Graham relished the scene in Dante's Inferno when Ulysses describes inspiring his crew to sail westward into the unknown waters beyond the gates of Hercules. "O brothers," I said, "who after 100,000 perils have reached the west, in this little waking vigil that still remains to our senses, let us not choose to avoid the experience of the unpeopled world that lies behind the sun. Consider the seeds from which you sprang. You were made not to live like beasts, but to seek virtue and understanding." With this little oration, I made my shipmates so eager for the voyage that it would have hurt to hold them back. And we swung our stern toward the morning and turned our oars into wings for the wild flight. Investing, too, is an adventure. The financial future is always an uncharted world. With Graham as your guide, your lifelong investing voyage should be as safe and confident as it is adventurous.